Um, can you all hear me? You all can send
Yes, sir.
message if everything is okay. If anybody can send me a message, if sound is clear and you can see the screen.
Yes, clear. Sounds okay.
You can hear, right?
Yeah.
All right, thank you. Okay, now this is our third class, right? So first class, we broadly talk about our financial system and its components, and you might be very clear on that. Now, previous class, we were looking at analysis of interest rate, right? So we will be continuing that session to this class as well. So I just want to recall what we have done in the last class. So we just discussed about what is interest rate, right? And then we talked about determinants of interest rate, especially production opportunities and time preferences for consumption. And then we talked about real rate of interest determinants. And then we discussed the equilibrium level of interest rate. So how do we arrive at equilibrium? That's also we looked at. That's we discussed like it's based on the desired serving and desired investment. And then we talked about economic forces that changes interest rate. What are those economic forces? And then we also discussed, even though we said the interest rate equilibrium might be based on the desired serving and investment, but we discussed that it might be difficult to decide that based on like in short run, right? So then we discussed loanable fund theory. That's like that elaborated like in short run how we can how interest rate can be determined, right? So we discussed loanable fund theory, and then we discussed the nominal interest rate and the real interest rate and differences and how to calculate, right? And then we discuss about Fisher effect. So based on the Fisher's theory, how we can decide an interest rate. What is the relationship between nominal interest rate, real interest rate, and the inflation, and how to calculate those effects. That's also we looked. And then we did a example how to calculate interest rate based on the Fisher effect. And then we discussed measuring interest rate, how to measure interest rate, right? So in finance, we talked about present value concept. So I use present value context to explain the measurement of interest, right? Interest rate, how to calculate interest rate. So now you know how to calculate present value. Through that, how we can arrive at interest rate, right? Okay, so then under this interest rate measurement, we discussed a simple present value, how we can convert future cash flows into present value terms. So we took all these future cash flows and discounted using interest rate and then arrived at present value. That's a simple present value computation, right? So now we discussed about yield to maturity, right? That's a key element always in finance. So we have to consider always the yield to maturity when you choose an investment. So that is the key one. So what is yield to maturity? That is an interest rate that equates the present value of cash flows received from a debt instrument with its value today, right? Okay. So then using this yield to maturity, we discuss 4 types of credit market instruments. It could be a simple loan, it could be a fixed payment loan, it could be a coupon bond or discount bond. So 4 types of credit market instrument we discussed. Into that, we identify like differences between interest rate or yield to maturity, right? You should be knowing that. Now, in a simple loan, how to calculate yield to maturity? So it's as usual, we used present value concept and we found one key evidence that for a simple loans, the simple interest rate equals the yield to maturity, right? Now you can see we have a simple loan, present value 100, right? That means amount borrowed, today value. You borrow $100 and end of 1 year, right? You will get $110. That means $10 in addition to the borrowed amount, right? So if you are a lender, so you give $100 today and end of 1 year, you will get $110, right? The period of loan is 1 year, right? Now, if you simply calculate interest rate, that's a 10% because 10% increase, right? And same time, right? Yield to maturity also. So what's the return you got from your investment? That's the yield to maturity. That's also 10%. Because now your holding period, that means you are going to hold this bond for 1 year and bond also matured in 1 year, or like loan. If you take in this instance, okay, loan also going to be matured in 1 year. So here for a simple loan, keep it in mind, interest rate equals the yield to maturity, right? For a simple loan, right? Okay. And we also talked about fixed payment loans, right? Fixed payment loans, earlier we discussed simple loan. Okay, now we are talking about fixed payment loans. That means every year, annually, you are going to pay back, right? So you have a loan value. That means what's the value of the loan today, right? To settle that loan, you are going to pay annual installment. That's a fixed payment until the maturity, right? Now you can see here, you are going to discount all these future cash flow. This is annual cash flows. So if you can discount or if you can calculate the present value of all these future cash flows, then you will get the loan value. So here also, right, you can see the interest rate. Clear? Right. And we talked about coupon bond. Here, this coupon bond is a little bit different from this loan because for loan, you are going to settle the loan using installments. So you will settle those installment or like borrowing amount using those installments. But when it comes to coupon bond, right? Now every year, annual, let's assume it's an annual coupon. So every year you are going to get the coupon, right? And end of the maturity period, you are going to get back the face value as well. So we discussed, and then as we discussed earlier as well, you discount all these cash flows and get the present value, right? Okay. So we discussed coupon bond, we discussed formulas, right? And we also discussed, right? We also discussed the price of a coupon bond and the yield to maturity are negatively related. The relationship between the price of the coupon bond and yield to maturity, right? So now you can see when the price of a coupon bond increases, your yield to maturity is coming down. That's what we discussed. Now you can see price of a bond 800. If a price of a bond is 800, then yield to maturity is 13.81. Yeah, you can work out and see, right? And then if the price of a bond is 900, so yield to maturity is, right, coming down, 11.75. So then the relationship between bond price and yield to maturity are negatively related. That also we discussed. And the perpetuity we discussed, that means there's no maturity. So now if we can assume like shares, of course, no maturity. So if you have a fixed dividend, right? So you can divide that cash flow by interest rate, or you can discount those cash flows and you get the present value, right? And then finally we discuss discount bond, right? In discount bond, that means you can assume a treasury bill, right? The treasury bill example maybe face value maybe 100 rupees, but you are going to buy it maybe 80 rupees, right? So what is your yield, right? So you can calculate the yield, right? It's given the formula I is equal the face value minus your price divided by your price. Price means your investment, right? So now if 100 a face value, if you take a treasury bill that the face value is 100, then if you are going to buy at 80 rupees, you are going to gain like 20 rupees. So 20 rupees. So a return, if you want to see the return, so 20 rupees divided by your investment is, that means price of the bond or bill is 80. So 20 divided by 80, maybe 25%, right? So we have seen this as well. Now we have seen, or we have discussed how to measure interest rate, right, for different products. And you have to keep in mind here, we all discuss all these scenarios based on annual cash flows. There's no biannual, right, or like once in 6 months or 3 months, not like that. All annual because of the computation, easiness of computation. But when you take the bond, most probably like biannual cash flows are in place, right? So this class, we are going to discuss the rest of the items in this interest rate analysis, right? I'm going to start with I, right? So first, we are going to discuss the distinction between interest rates and returns, right? Now you have to be very careful, like when you invest, right, on a bond, right? Let's assume on a bond, right? 5-year bond. right? So it says coupon rate is annual coupon rate is 10%. Then do you think that 5-year coupon, 5-year bonds, 100 rupees worth of bonds, it's going to yield 10% per annum? That's a coupon rate. So do you think the rate of return is 10%? That's the question. Now, if you are going to invest on a bond, then you may think, okay, the coupon rate is 10%, so my return will be 10%. If you think like that, that's wrong. You are thinking about only the coupon rate, because every year you are going to get 10%, right? That's what, as a coupon, that's what you are thinking. So one cash flow, that means coupon rate cash flow, you have considered, right? But my point is, end of 5 year, right, you are going to get face value also back, right? Let's assume we are going to sell that bond in 4th year. But if you, at the maturity, if you are going to get, anyway, you are going to get the face value, no issue. But if you are going to sell that bond before the maturity, at what price you are going to sell? That's the question. Of course, coupon 10% you will be getting annually, there's no issue. But if you are going to sell the bond before maturity, how much you are going to get? What is the price of that bond? That is the question. If the price is the face value, there's no issue. But the price will be decided by the market interest rate. That is the problem. Even though your coupon rate is 10%, end of 4th year, the market interest rate may be different. So then your price of the bond may be different, right? That's the problem. So then if you want to calculate the return of your investment, rate of return, so you have to consider not only cash flows on coupons, but also cash flow of the capital or face value. In other words, the payments to the owner plus the changes in value expressed as a fraction of purchasing price should be the return. Now, you, as we discussed, you can see RET, return, equal, right, C divided by P. C means coupon payment divided by P, price of the bond, right? Okay, PT, today's price of bond. So then how much the coupon rate you will get, plus the price changes between PT and PT plus 1. That means price today and price tomorrow. T means today, T plus 1 means tomorrow. So you take tomorrow's price, like tomorrow's price, and deduct today's price and divide by today's price. You will get the changes in the price, bond price, right? So if we can combine together, so if I want to reiterate again, the first part of this formula talk about the coupon rate, and second part is talk about the changes in the value of the bond, right? So then you have to take both together and calculate and see the return. So RET means return from holding the bond from time t to t plus 1. PT means price of bond at time t. I just explain again. PT plus 1 equal price of the bond at time t plus 1, right? Maybe an additional year, or that can be any future period. So C, coupon payment. So now if you want to calculate the current yield based on the coupon payment, that is your interest rate, C divided by PT, that is current yield. I call it IC, current yield of coupon. Then you take second part, PT plus 1 minus PT divided by PT. That's a rate of capital gain. That is G. Okay. So here you can see, right? You can see when you say return, that is I plus G, right? That is I plus G. So these are the differences between interest rate and return. So interest rate, you are going to talk about only yield to maturity. But if a return, if you are going to talk about return, that is not only yield to maturity, but also capital gain, rate of capital gain. Is that okay? Any question? I didn't get any messages from asking any questions, so I think this is clear, so I can move on to the balance part, right? Okay, now based on this example, now you can conclude a few thoughts under this. The first, the return equals the yield to maturity. The return equals the yield to maturity only if the holding period equals the time to maturity, right? Think about clearly. The return equals the yield to maturity only if the holding period equals the time to maturity. Okay, I go back to the previous slides and show you. Now return, this return, right, would be equal to yield to maturity. Which one is yield to maturity? The C divided by PT, current yield, right? So now you can see when this return is equal to this, the first part, when the second part, if the second part is 0, then the return would be equal to yield to maturity. When that second part would be 0, price T equals to price T plus 1. That means today's price, if the today's price is equal to tomorrow's price, so 1, if it is T plus 1 is 1 year, then if today's period is equal to 1 year period price, then when you deduct PT, today's price, from tomorrow's price, that should be 0. When these two prices are 0, two prices are same, then there won't be any capital gain, right? So now question is, when would be that 0? When would be that 0? That means face value and the final value, redemption value, would be 0 when at the maturity. That we know, 100% we know, right? At the maturity, you are going to get the face value back. So your price, today's price, and that maturity price, so would be same, right? So initial price and the maturity price would be same if you are going to. So then for that, you are going to hold that bond up to maturity. That's what it says. The return equals the yield to maturity only if the holding period equals the time to maturity. That means holding period equals the time to maturity. So if you hold that bond until the maturity, you don't get any capital gain or loss. So then your return equals the yield to maturity. Is that okay? Anybody? Any issues? Okay. So now the second point, a rise in interest rate is associated with a fall in bond price that we have seen. When the interest rates are rising, bond prices would fall, right? So now you think that bond, the coupon rate is 10%, right? Annually, every year you will be getting 10% coupon. That's no issue. If the bond is 100 rupees, you will be getting 10 rupees every year. There's no issue. But only thing is, when the market interest rate is increasing, your bond price will fall. That means if you are going to sell that bond, you can't sell at 100 rupees. You can sell lesser price, at a lesser price. So if you can sell at a lesser price, this is what we discuss throughout this. So you should have that in mind always. When the interest rate rises, so bond price falls, then resulting in a capital loss, right? If the time to maturity is longer than the holding period, that means what? You have time to maturity 5 years, let's assume, but you are going to sell before that. That means your holding period is less than that. If the time to maturity is longer than the holding period. So if you are going to sell the bond before maturity, so first sentence we saw, the returns equals the yield to maturity if the holding period equals time to maturity. But now second we are discussing, the second point we are discussing, the interest rate is associated with a fall in bond price, resulting a capital loss if time to maturity is longer than the holding period. Right? Third point, the more distant a bond's maturity, the more distance. Now let's assume today you are in a year 2. The bond is matured in 10 years time. So you have the distance of 8 years. Right? Now if you are in year 6 and the bond maturity is 10 years, then your distance is 4 years. That's what the more distance, when we say distance to maturity, is like that. The period between today and the maturity. So if you have more distance, the greater size of the percentage price change associated with the interest rate change. So you have to, in other words, if the distance is higher, you will have a price fluctuation more. percentage price change would be more, right? Like if you are not, you just, if you are not convinced about that, you can work out and see, right, how that changes when the distance period or like period between today and the maturity is longer, right? And other one, the final one, that's a general observation. Interest rate don't always have to be positive, right? Sometimes interest rate might be negative as well. That means you will be losing more, right, by serving or by investing, right? So that can be due to several reasons. Now you can find some some, you can refer some literatures and see Japan experience or European experiences. So sometimes those economies run at a negative interest rate, right? Now you might be able to answer like questions like what is the distinction between interest rate and returns, and what are the observations on these differences, right? You should be able to understand. Now the more distant a bond maturity, the lower the rate of return that occurs as a result of an increase in interest rate, right? What I want to say here is, in an increasing interest rate scenario, right, if the distance is more for a bond's maturity, the rate of return would be lower, right, compared to other distances. Even if a bond has a substantial initial interest rate, its return can be negative if interest rates rises, right? Okay, just see this table 2 example, right? I'll explain column by column. You can understand. Now, first column says years to maturity when bond is purchased. I purchased today, right? We can go from bottom to top. The first one is the bottom, like I'm asking you all to look at from bottom to top. So first bond, the years to maturity is 1, and second 2, third 5, and fourth 10, fifth 20, and sixth 30 years to maturity. Now in the question it has been mentioned that 1 year returns on different maturity 10% coupon rate bonds, right? So 10% coupon rate. So initial current yield. So every year you are going to get 10%. So your current yield, initial current yield is 10%, right? So you can think of now, today you buy a bond and it's matured in 1 year's time. It carries 10% coupon rate. So initial current yield, right? We usually calculate based on the formula, the previous formula. You can think the first part, return first part, cash flow coupon divided by price, right? So now you can see initial current yield. That means now 10%, right? That means 100 rupees maybe, right? You can calculate and see, yeah, 10% of 1000 initial price 100 rupees. So now what is the yield? Initial current yield 100 divided by 1000, that means 10%. Now end of the year, end of the first year, right? End of the first year, you're going to get your face value back. Hold on. Okay, end of the first year, you are going to get coupon 10% and you are going to get the face value back, right? So now nothing, there's no loss or no gain from your face value. That means your rate of capital gain is 0, right? So your rate of return, you can, as we discussed earlier in the formula, the rate of return will be initial current yield plus rate of capital gain. So initial current yield is 10% and rate of capital gain is 0. So then your rate of return is 10%, right? Now see this question. I read this question again. 1 year return on different maturities, 10% coupon rate bond. When interest rate rise from 10% to 20%, right? Now here you are saying 1 year return on different maturity. You are seeing only 1 year return, right? On different maturity, right? 10% coupon rate bonds. The difference here is the interest rate rises from 10% to 20%. Right? Okay. Now, if you are going to invest or you already invest on a bond that has maturity period of 2 years, every year you will get a coupon 10%. There's no issue. But the problem is you are going to get the, right, your face value or initial price, right? I can call you like if both are same. So then initial price 2 years down the line, right? But the problem is now we are calculating price for the next year. 1 year return, that's what we are calculating. 1 year return means price at like end of the first year, right? So now you will get a coupon, of course, okay. But the problem is this 1000, now you are going to sell. You assume like that. That means you are going to calculate the price of that bond end of 1 year, but you have another year for mature. You have distance of 1 year. End of 1 year, you have another 1 year to maturity. Now the question is, the interest rate has gone up to 20%. Just to keep in mind, so you can better understand. Now let's assume I have a bond, its yield is 10%. But now suddenly in the market, you will have another bond which has 20% yield. The investor preferences would be on my bond or that new bond. My bond will give only 10% yield, but the new bond will give 20% yield. So investors are going to invest on that bond, not this bond. Unless I reduce my price to equate that interest rate. That is the case here normally. That is the, the practical example, right? So if you like demand supply example now, but the calculation is there. So then we have seen the calculation, how to discount that, right? So now the end of 1 year, my 2-year bond would be sold at 917 rupees. You can't sell at 1000 rupees because the interest rate has gone up. So due to that, price has come down, right? So now you will get 10% yield, of course, okay, but your rate of capital gain might be now minus 8.3, right? So now you are making loss because the market interest rate has gone up to 20%. So what is the rate of return now? That means the column 2 plus column 5 percentage. So that means column 2, 10%, but there's a capital loss of 8.3%. So your net return or rate of return is only 1.7%. This is what I said. Even though you think, okay, there's a 10% return, that would not be the case. The rate of return, if you calculate and see what is the important thing for an investor, that's a rate of return, right? You can't just, or any investor cannot just blindly go for this 10% yield, because they have to think about the interest rate changes in the future and the loss or gain due to that for that investment. So first year you got, if you have a like 1 year bond, that would be 10% rate of return. But in this situation, if you have a 2-year bond, you will get only 1.7%. Similarly, if you have a 5-year bond, your return, rate of return would be negative 15.9%. Right? Here you have to think, when the interest rate goes up, then your value of the bond will come down. So then that will be negatively affecting your rate of return. That's the one thing. And second thing, if the distance is higher, your loss rate of return would be higher. Right? Is that okay? Any questions so far? Okay, if there's no question, so then we can go to the conclusion, right? Now, maturity and the volatility of bond return, right? What we have seen, when the maturity is higher, then the volatility of bond returns. What will happen to the volatility of bond returns? Now, in the previous table, when the maturity is increases, you can see in a rising interest rate scenario, this capital gain, rate of capital gain, it's increasing, right? Okay, so price and returns for long-term bonds are more volatile than those for short-term bonds. Now you can see the percentage of changes, right? So the changes on a long-term bond is higher than the short-term bond, right? You can see here the short-term bond may be 8.3, but long-term bond 49.7, right? Okay, so now the total rate of return, you can see, right? Long-term bond, if you take 5-year, that's 15.9%, and if you take 30-year, that is 39.7%, right? So then price and returns for long-term bonds are more volatile than those for short-term bonds because of the uncertainty. There's no interest rate risk for any bond whose time to maturity matches the holding period. This is the key, right? Now, let's assume, like I will just explain the second sentence. Now, if you're going to hold any bond until it's mature, then you won't have any changes in the price. That means there's no interest rate risk. What do you mean by interest rate risk? The losses arising from, the possible losses arising from changes in the interest rate. We have seen if you can hold a bond until maturity, you are not going to lose anything, right? So your capital gain or loss would be 0. So then you are not going to lose anything. That means there's no interest rate risk. But if you are going to sell a bond before maturity, you will have interest rate risk. That means due to the interest rate changes, the price of the bond going to be changed. And longer the maturity period, higher the fluctuation. So higher the interest rate risk. Is that okay? I hope you understand. Okay, so then up to now, we have seen interest rate, yield rate, and return on investment, right? So these 3 items you should be thoroughly understood, right? Okay, now I'll be moving into the other area, right? Determinants of asset demand. Economic agents hold a variety of different assets, right? Economic agents hold variety of different assets. So which assets can they hold, right? That's a big question. So they have variety of question, like assets. So which is better to hold, right? That's a question. Now, what do you mean by asset? When you say assets, there are 2 attributes of assets that should be, or that can be owned by economic agent, and that should have a value. So should be, or could be owned, and it should have a value. If you can have both together, these attributes, we can call it asset. Now, for an economic agent or an individual household or firm, right? How they are going to decide whether I should buy this asset or buy and hold this asset or buy these assets rather than going to buy different assets? How to make a decision on buying assets? There can be four items, right? Basically considered, factors basically considered for this decision making. First one is wealth. My wealth would be a deciding factor on a purchasing of assets. Whether to buy assets or whether to buy a bond, this bond or treasury bills, treasury bonds or shares or corporate bond. So that decision making would be influenced by first wealth. Second, expected return. That means the expected return over the next period on one asset related to alternative assets. So if I'm going to buy a treasury bill or if I'm going to buy a treasury bond, I'm going to compare this treasury bond with corporate bonds and see which one gives more expected return. So I prefer normally like, higher expected return beneficial to me. So then I will be preferred to higher expected return. So third, risk. The degree of uncertainty associated with the return on one asset related to alternative assets. So the risk appetite of the assets. Some assets may be less risky, some assets may be more risky. So that is based on the investors' risk preferences. Some people may not like risky assets. Some people may like risky assets because maybe return may be higher. So risk also one of the item or factor that influence your decision. The final one is liquidity. What do you mean by liquidity? The ease and speed with which an asset can be turned into cash relative to alternative assets. So like easiness and speed of convertibility of an asset into a cash or near cash. That's a liquidity. So normally people prefer for assets which can be converted easily, right? So if you go for a treasury bills, anytime you can convert. If you can go for a share investment, yes, high liquidity but more risky. Or if you can go for a corporate debenture, no, that may not be highly liquid because if it is listed in a stock exchange, you can't sell it immediately. So that's a problem. Or maybe land. Let's take a land. Can you easily or speed convert those assets into cash? No. This is not easy because a lot of documentation. So agreements all are in place and it won't like easily you don't find the price. So it's very difficult. So now you are going to choose whether I'm going to invest on treasury bill, treasury bond, corporate bonds, or stocks, or land and building. That's based on the wealth, expected return, risk, and liquidity. Right? So when you make a demand, so that means if you want to buy an asset, there are factors that influence your decision. Okay, now as we discussed, all the determining factors we have just discussed can be assembled into the theory of portfolio choice, which tells us how much of an asset people want to hold in their portfolio, right? Now, these all factors, what we have discussed, right, contribute you to have a portfolio of assets. Based on these factors, right, you're going to have a portfolio of investment that is we call theory of portfolio choices. How we are going to make your portfolio? Now you have wealth. How we are going to make your portfolio? Some of the wealth will be invested on treasury bills, some of them will be on shares, some of them will be on land and building, right? That's your portfolio choices. Now, theory of portfolio choices, by taking into all these consideration, that has given, right, an idea how to decide investment. Now you can see the relationship between this every factors and your decision or demand for assets, right? So whenever like we discuss about demand, there may be so many factors influencing those demands, but when we discuss a single factor, we assume that other factors are fixed, ceteris paribus, right? Here also same way, holding all of the factors constant. The first point, the quantity demanded of an asset is positively related to wealth. When your wealth increases, you will demand more assets. When your wealth decreases, your demand for assets will decline. That you know, right? Okay, right. The second, the quantity demanded of an asset is positively related to its expected return relative to alternative assets, right? Now let's assume like we are going to buy a treasury bond or a corporate bond. You are going to decide now. You think your expected return, right? Here you have to think, right? We are talking about expected return, right? What is the return we talked about? Yield plus capital gain, right? That's the expected return. Now, when you think like expected return of bond is higher than the corporate bond, expected return of the treasury bond is higher than the corporate bond. So treasury bond means issued by treasury government, right? The corporate bond means issued by corporate, right? Okay, so now if an investor think, right, if an investor thinks that the treasury bond gives higher return, then his demand for the treasury bond will be higher than corporate bonds. So that's what it says. The quantity demanded of an asset is positive related to its expected return relative to alternative assets. So here, like we always talk about alternative assets, right? And third, the quantity demanded of an asset is negatively related to the risk of its return related to alternative assets, right? Now let's assume you are again comparing treasury bonds with the corporate bonds, right? If you feel risk of corporate bonds is higher, right? You are going to demand less. That is the negative relationship. If you feel any assets that is risky, then you will reduce the demand and go for the less risky assets, right? You have to think about, I have already mentioned assumption, holding all of the factors constant. Now some people a little bit confused because like if the risk is higher, definitely return might be higher. That's true. But that's what here I have already said. All of the factors constant. I am just talking about risk only. That means return is constant, nothing change, equal return, right? Or nothing change. Now the one asset's riskiness is increasing, then your demand is going to be low for that asset, right? That is the negative relationship. And fourth, the quantity demanded of an asset is positively related to its liquidity relative to alternative assets, right? Now, like there's a company, its stocks are listed in Colombo Stock Exchange, right? And there's another company not listed, right? Now, if you want to invest on shares, right? Invest in shares, then which one you prefer? The share which is listed in Colombo Stock Exchange or not listed one? A rational investor will like to invest on shares that is listed because anytime you can sell it. So highly liquid compared to unlisted shares. So then the liquidity and demand are positively related. If the investment is highly liquid, then your demand would be higher, right? Based on these four factors, right, the theory of portfolio choice explaining the relationship, right? That's what we have seen. I hope that's clear. Now you can see a summary table. It says response of the quantity of an asset demanded to changes in wealth, expected return, risk, and liquidity. As I discussed, when the wealth increases, the quantity demanded would increase. When expected return related to other assets increases, yes, demand would increase. The risk related to other assets increases, demand is going to be lower. And liquidity related to other assets, if that is increased, then your demand also will increase. Is that okay? Here, like what we have mentioned is all these factors when the factors increases, right? So you can be a scenario like all these factors are decreasing. So what will happen to the quantity demanded? That might be other way around, reverse. Now here I have given wealth increases. So there may be a question wealth decreases. What will happen? Right? So you should be able to understand those. Right? So theory of portfolio choice give the clear explanation for these factors. Any question? Okay. Now I'm going to move into the different perspective, right? That means supply and demand in the bond market. Okay. Now, at a lower price, ceteris paribus. So that means other factors are constant or no change in other factors. At lower prices, the quantity demanded of bond is higher, right? An inverse relationship. So if a bond has a low price, your demand will be higher, right? Normal demand curve, you can remember, right? Similarly, right, if the price is lower, your demand of bond is higher. At lower price, the quantity supply of bonds is lower than a positive relationship. You can think of now, in the bond market, I am the issuer of bond and you are the buyer of bond. Bond price is lower now, right? Oh, I am the holder of bond, you are going to buy that bond. Now interest rate has gone up. Interest rate has gone up. What will happen to my bond price? Will come down. Now the 1,000 rupee worth of bond now is trading at 500 rupees. So now you anyway would like to buy that one because the price is lower. But that means there's an inverse relationship between bond price and demand. But I don't want to sell it now because the bond price is low. If I sell my bond at that price, I will lose a huge amount. So then I don't sell it. So then at a lower price, the supply of bond is lower. That is a positive relationship. Right? Okay. Now, the relationship between bond price and interest rate, right? That means the yield to maturity of a discounted bond is how to calculate? I is equal face value minus price divided by price. We discussed that. And yield to maturity of a console or perpetuity bond is IC equal C divided by PC. Right? Okay? Clear? Right. So now the yield to maturities are calculated in this basis. Okay? Now let's look at how we can see this in a graph, supply and demand in the bond market. Right? Okay. Now in this graph, okay. Now in this graph, you can see what happened to the supply and demand for a bond. Now let's assume the first I'm going to talk about bond demand, right? At the, like, if the bond demand or bond price is 950, bond price is 950, right? So bond demand would be 100. So you can see in the y-axis is the price of bond, and you can see in the x-axis it's a quantity of bond B, price P, and bond B, quantity of bond. Now at a price of 950, you can see, right? You can see the demand, that's $100 billion. So it's very low. Now let's assume the prices are coming down now. Now the price is 900, right? When the price is 900, now demand is increases. Demand for bond is increases, that is 200, right? So when the price is coming down every time, the quantity demanded increases. Why these prices are coming down? Because the interest rates are going up, you can see, right? So same thing. Now you can see the bond supply curve. As we discussed, demand curve indicates a negative slope, that means negative relationship. The supply curve indicates a positive slope, right? That is a positive relationship. Now we have seen the bond demand curve. Now what happens to the bond supply? At 950, yes, suppliers are very happy, high price, they are going to supply 500. But now prices are coming down. Now this 900, now bond price is 900. So then the suppliers are not happy, so they reduce their supply. Now it's coming down again 850. Of course, they are going to reduce again. So now it's 300 they are supplying. So every time the prices are coming down, the quantity of supply of the bonds also coming down. Right? So this is the problem. The price and demands are negative related and price and supplies are positive related. Now, how to arrive to a market equilibrium? Now the problem is, when the price is 950, you can see the demand is 100, but supply is 500. So now excess supply in the market. So then prices are coming down slowly. Because there's a huge supply, less demand, so prices are coming down slowly. So if you look at the bottom line at 750, right? At 750, demand is 500 billion, but it's because of lower price, the supply is only 100 billion. So with the excess demand, the bond price rises, right? So both, whatever the one of these ways, the prices are changing. And at one point, that means 800 price at 850, both supply and demand would be equal at a point C. So the price might be, bond price might be 850, and the quantity demanded and supply, that means equilibrium quantity, is 300. So bond market reach the equilibrium in this way, right? Clear? Now you know how bond market equilibrium bond market equilibrium is determined, right? Okay. The market equilibrium, you can see, market equilibrium occurs when the amount that people are willing to buy equals the amount that the people are willing to sell at a given price. So accordingly, 850 is the equilibrium price and 300 is the equilibrium quantity, right? At a given price, that means 850, they are now willing to buy and sell 850 worth of bond. The equilibrium conditions, so BD, bond demand equal bond supply, defines the equilibrium. So we call it, when we call it like equilibrium or market clearing price and interest rate, right? Okay. So you also should consider, as I explained, if the bond demand is higher than bond supply, there's an excess demand, price will rise and interest rate will fall. When the bond demand is less than bond supply, there's excess supply, then price will fall and interest rate will rise, right? So be clear the relationship between each and every variables. So sometimes it may be confused. That's what I'm saying again and again, right? Given the context, you should be able to analyze what will happen to the equilibrium. Now, okay, you are at equilibrium. Now we discuss earlier, right? So other factors are constant. So we were talking about prices and quantity, price of the bond and the quantities. Now, the equilibrium may, that means the supply and demand in bond market may change due to the other factors we have already discussed, right? So that can be wealth, that can be expected return, that can be expected inflation, or risk, or liquidity. Based on this, now demand or supply can be changed. So let me look at this, how the changes in equilibrium interest rates. Okay, now shift in the demand curve for bonds. This, I go back to this graph and see. Now you can recall your high school demand, law of demand. So law of demands always talk about the relationship between prices and the quantity, right? When the price increases, quantity will be low. When the price decreases, quantity will be high. That's a law of demand for normal goods, right? So now when this changes will happen via the demand curve, right? When the quantity reacts to the price changes, the movement will be through the demand curve, along with the demand curve. But other than these prices, when other factors hit the demand, that shift the demand, right? So here also, other than these prices, we talked about wealth, expected return, expected inflation, risk, and liquidity that will shift the demand curve, right? Okay, now assume like wealth. If you have more wealth, that means your growth increases. The demand curve for bonds shift to the right, right? Okay, clear? So you should be able to now understand the changes in the price and changes in the other factors. When changes in price, the quantity demanded will be changed along the curve, but other factors that shift the curve, right? So second item, expected return. So high expected interest rate in future lower the expected return for long-term bond, shifting the demand curve to left, right? So if you think the higher expected interest rate in future, right? You think, okay, in future, the expected return would be higher. Then lower the expected return for long-term bond, shifting the demand curve to the left. Because now the problem is like you are expecting for the future return to increase, but you have your bond with you, right? Right? Or like you are planning to buy the bond. So, but you think no, future return will be higher. Now, then you don't buy now. So then what will happen? The curve move to left. And third one, expected inflation. An increase in the expected rate of inflation lowers the expected return for bond, causing the demand curve to shift to the left. Now, whenever you talked about expected inflation, you think of Fisher effect, right? So if you think like expected inflation will be higher, then what will happen to your real return? It's going to be low. Then you don't demand now. That means your demand curve shift to the left. Is that okay? Right. And then risk. An increase in the riskiness of bond causes the demand curve to shift to the left. Okay. When there's a higher risk, you don't demand more. So your demand will come down, the curve will shift to left. And liquidity. Increased liquidity of bond results in the demand curve shifting, right? Because like when you think, okay, liquidity is increasing, okay, you can sell it at any time easily without any loss. If you think like that, okay, you demand more, right? So then when you demand more, the demand curve shift right. Now we have seen 5 factors. When the 5 factors are increasing, what will happen to the demand curve? It may move to left or right. It's based on the scenario. But you can look into other way around also. Like if the factors, those factors decreases. So wealth decreases, expected return decreases, expected inflation decreases, risk decreases, liquidity decreases. What will happen to the demand curve? So that also the opposite side you can think of. Okay. Now I'll show you in this graph. An increase in the demand for bond, right? So when the demand for bond increases, that shift the bond demand curve right. Okay, moving right. You can see in the graph. This is what I said, right? So like here, like shifter to right. Clear? Right. BD1, the blue color line. Now it has moved to B2, BD2, the new demand curve, because of various reasons or changes on wealth, expected return, or expected um, inflation or risk or liquidity based on the expectation. This can move right or left. Now I have given all together here what will happen to the changes in wealth. You can see when the wealth increases, demand increases, so then the curve shift right. When expected interest rate increases, then demand coming down, then demand curve move to left. Expected inflation, when the expected inflation increases, your demand will come down, then curve move to left. Riskiness, when the riskiness increases, demand will come down, then demand curve move to left. When the liquidity increases, you will have more demand, then demand curve move to right. Okay, I'm not going to discuss in detail because like I know like you all might have done advanced macroeconomics, so or like in general terms, so then you can easily understand this one. Or if you have any question, then you can post your question. Next, we are going to see this, what happened to the supply curve of bonds, right? An increase in the supply of bond shift the bond supply curve rightward. Okay, so when the supply increases, we will have movement towards right. Okay, now we can see what are the factors influencing the supply curve. The first one, the expected profitability of investment opportunities. In an expansion, the supply curve shift to the right, right? Okay, now let's assume I am the issuer, right? I'm a corporate. I'm going to issue or supply bonds, right? So now, if I'm going to issue a bond, what's the purpose behind that? Because I want to borrow money from you, right? Why do I need money? Because taking the money and then I'm going to invest on some other projects, right? That is my investment opportunities. If that investment opportunity provide a higher profitability, then I try to invest more. Then if I want to invest more, I will supply more bond to get the fund. So when the profitability of an investment increases, so definitely supply of bond will increase. So the supply curve will move to right. Right? Now, very interesting factor, expected inflation. An increase in expected inflation shift the supply curve for the bond to the right. So if we have an expected inflation high, if we expect the expected inflation will go up, all right, you expect inflation will go up, what will happen to your supply? The supply also increases. Why? Could you remember, like we discussed, due to the expected inflation, right? You can go back to Fisher effect. When the expected inflations are higher, your real return would be lower. That beneficial to the issuer we studied earlier. Why? Because he is going to, the real return what he is going to pay is less now. So that is beneficial for the issuer. So then if you think like the inflation will be higher, that means expected inflation is higher, then you will supply more. So then your supply curve move to right. You can see in the graph, bond supply curve blue, that means 1, BS1, move to BS2. And what else? Now you can think, because we have studied all, right? We have discussed all. The third point is government budget, right? Government budget. When the government budget is deficit, that means what? The government need to fund or borrow to make the budget balance, right? So if they want to borrow more money, they have to issue bond. Then what will happen? When the deficit increases, the bond supply will increase. So then the supply curve will move to right. Right? Okay. Now this actually like this interest rate analysis subject, unless you thoroughly linked, right, with each and every variable, right, there may be some kind of confusion, right? So you can ask any question if you have anything. I hope like I have like discussed in an orderly manner so that everyone can understand, right, easily. Okay, so is that okay? Any question? Okay, now look at this. You take, right, as I explained, if you take this response to a change in expected inflation, right? Now, as we discussed, this expected inflation will have an impact on demand, at the same time supply, right? Now, initially, the equilibrium was at P1, right? The price 1, the blue color curves, right? BD1 bond demand curve and BS1 bond supply curve. That is the initial equilibrium, right? Now you can see step 1, you can read and see a rise in expected inflation shift the bond demand curve leftward. Okay, now assume the expected inflation is rising. What will happen to the demand curve? The demand curve move to left because demand will be less. Because if you expect a higher inflation, your real return going to be lower, then you don't try to buy. So then your demand will come down. That's one point. That's a BD2, red color demand curve. The same thing, the step 2, and shift the bond supply curve rightward. Now bond supply will increase. Why? You expect inflation would be higher in the future. So the real return what you're going to pay is less now. So you try to supply more bonds because you are better off now. So now bond supply curve will move from BS1 blue color to BS2 red color. Right? What will happen to the final equilibrium? Now step 3, causing the price of bonds to fall and the equilibrium interest rate to rise, right? Now bond price, what will happen to the bond price? Now that will be settled at P2. The equilibrium earlier it was 1, now it's 2, right? Both red lines BD2 and BS2 intersect at 2, right? So when the bond price decline, equilibrium interest rate will rise. That we have seen that one, right? Okay. Now, due to this bond market activities, what will happen to the interest rate? Also, we have seen. Okay, this is because of the expected inflation, right? Okay, up to now, if there's any question, now we have discussed in this first session, right? We discuss interest, yield, and the return, and the demand for assets and supply of bond, demand of bond, and the equilibrium conditions, right? So what's happened to the interest rate? What's happened to the price of a bond, right? What happened to the quantity demanded and quantity supply of bonds, right? So we'll go for a 15 minutes break. Okay, let's look at now the supply and demand in the market for money, right? We call it liquidity preference framework. Now, up to now, we have discussed the supply and demand for bonds and its market equilibrium, right? But alternative to this framework, Keynes developed a model, alternative model, that we call liquidity preference framework, right? Or liquidity preference theory. Here, it says the interest rate determinants is based on supply and demand for money. Earlier, we have seen the interest rate is determined based on the supply and demand of okay. Sometimes interruption happens. Okay. Now, earlier we discussed the interest rate determinants or equilibrium based on the demand and supply for bonds. But Keynes developed a different model that's called liquidity preference framework. It says the equilibrium interest rate, it developed like the framework that captured the equilibrium interest rate based on the supply and demand for money. So it's, in brief, it says like interest rate equilibrium occurs in a framework of money supply and money demand. So you can see that although the two frameworks look different, right? The liquidity preference analysis of the market for money is closely related to the supply and demand framework of the bond market. So even though like there are two models we are discussing, right? So both models are very closely related each other. Okay, now carefully look at this. Keynes assumed that there are two main categories of assets that people use to store their wealth. One is money and other one is bond, right? This is the assumption, so nothing else, right? So whenever you are going to talk about the equilibrium interest rate, you have two alternative assets, right? That is money and bond. No other assets are considers, right? So then this model is all about between money demand and supply, and then you have to think about as an alternative assets bonds. Okay, now the total, so accordingly the total wealth in the economy, right? Bond supply or money supply. You got it? Now you have the wealth. You can invest or you can store those wealth in two assets only. That is money and bonds. Right? We always, when we study about money, we always talk about it's an instrument which can be used to store wealth. Right? Now the Keynes assume there's two assets in the economy you can store wealth on. That is bond, other one is money. So total wealth could be equal to bond supply plus money supply. So how much bond available in the market and how much money available in the market. So BS plus MS, right? In an equilibrium condition, we know, right? BS should be, bond supply should be equal to bond demand and money supply should be equal to money demand at an equilibrium, right? So the total wealth then, if it is BS, bond supply plus money supply, then that should be equal to bond demand plus money demand. If you can rearrange this one, right? Bond supply minus bond demand should be equal to money supply minus money demand, right? So in a condition, if the market for money is in equilibrium and the bond market is also in equilibrium, if that is the condition, so this formula should be or could be written in such a way. Is that okay? Right. Now look at this equilibrium in the money market. Now we have discussed earlier, I just go back to the previous slide. in a money, if in a money market or market for money. So like I just want to clarify one thing, like market for money, right? We are talking about market for money, but there's another term, money market. That's different, right? That's different. I'm not talking about that one here, right? This is market for money. So market for money means money supply and money demand we are talking about. So money market, it's a short-term market for financial assets, right? That's different, right? Here, that's what like wording is based from the text, market for money. Sometimes when we talk, like we just call it money market equilibrium. So it doesn't mean like that short-term money market, or like this is, I'm referring here as market for money, right? So here, the equilibrium, as usual, will be at a point where the money demand and money supply curve intersect, right? Here in this equilibrium, the Keynes says, like this is the graph, the y-axis says like that is interest rate, and x is like noted by quantity of money M. So y interest rate I in percentage, and x refers the quantity of money M in billions, right? Okay. Now you can see the curve. You can see the curve, right? First we start with money demand curve, MD, right? Now look at this carefully. At a rate of interest rate is 25%. Interest rate is 25%. Money demand is 100 billion. Here, when you say money demand, how much money people willing to hold at a given interest rate at a time, at a point of time. What's money demand? How much money people willing to hold, right? Now let's see. I have my salary, right? So how much I want to hold as a cash? How much I want to hold as a cash and maybe demand deposits, right? You can refer, right? Right? What is the monetary base or something like that, right? I don't want to go into so details now, but how much you want to keep as a money, right? When the interest rate is 25, you want to keep $100 billion with you, right? That's a point A in the money demand curve. Let's look at this. The interest rates are coming down 20%, from 25 to 20%. Now I want to hold lesser money at 200 billion. The question is why? What I'm going to do with balance money, right? Because now, right? Or like now I'm just going to hold 200 billion, but earlier I just hold only 100 billion, right? So where this 100 billion coming from, or where this going out, right? We have to carefully understand. As I said earlier, the Keynes said, he assumed that there are two main categories of assets in the economy where you can store wealth. One is money, other one is bond. Now you are going to choose one of them to store your wealth, right? Now the question is how you are going to choose. how you are going to choose, right? Now that if you take the attributes of two assets, if you are going to keep your wealth in money, you are not going to earn anything, because you are going to keep your wealth as money. It's not going to earn anything. It's just think about, you keep your money under pillow and sleep. After 1 year, if you keep 100 rupees, that's 100 rupees. It's not going to grow. But if you store your wealth in a bond, that is going to earn some return. That's what we started earlier. So your wealth is going to grow. Now the question is, where you are going to store your wealth, right? On money or in bond, right? Now think about, when the interest rate is high, you wanted to hold your wealth in bonds, because that will earn more money because interest rate is high. But interest rate is low, what will happen? You are going to store your money, maybe your wealth on money, because interest rate is so low. Yeah, you don't want to, right, invest, or you want to keep that money as high liquid, because you think the interest rate is not going to compensate your liquidity. Now that's what you can see. At higher rate, you hold little money, but at a lower rate, you demand more money. See the demand curve now? At higher rate, that means 25%, you hold only 100 billion, and balance you are going to invest on where? Bond. But at a lower rate, maybe 5%, you're going to hold 500 billion with you, and you are going to invest only little money on bond, because you think keeping as liquidity asset or as money is better than getting the small portion of interest rate. So that's what this demand curve of money, right, has negative slope. It's moving top to bottom, from left to right, right? Okay, this is the demand curve for money. With excess supply, okay, I will come back to you that again. Okay, now let's assume, now you know demand curve for money, and there's another curve, money supply, MS. This is a new curve, right? This curve, right, is not going to change, or like demand, like supply, money supply is not going to change in line with the changes happens in interest rate, right? Whatever the changes in the interest rate, money supply is fixed at 300 billion. The rationale behind that is, we say, the Keynes articulate that the central bank determine the money supply. It is not based on the interest rate. It's not changing based on the interest rate, right? So central bank fix the money supply. It's not changing in line with the interest rate. So it's a straight line. It's a straight line perpendicular to exists. Clear? So this supply curve is totally different from other supply curve. You should be bear in mind. Right? You should bear this in your mind that the money supply curve is always a straight line, and money supply is not going to change in line with the changes in interest rate. Now then, you can see the equilibrium interest rate when the demand curve and money supply curve intersect at point C. So interest rate is determined at 15%. That is I star. Normally, for interest rate we say I, and equilibrium interest rate we usually mention I star. Right? So in this liquidity preference framework, right, that is based on the money supply and money demand curve, right? So money demand, right, based on your liquidity preference, you are going to keep it on money or you are going to invest on bond. Based on that, this money demand curve will be drawn, and then combining with money supply curve, you can establish the market equilibrium. Now you can see the point A of demand curve and the money supply curve. That is, with the excess supply, the interest rate falls to I0, so I star, right? So when the money supply is excess to the demand, money demand, then your interest rate will fall. Other hand, if the money demand is excess, right, you can see the point E, the money demand is in excess, so then interest rate rises. Clear? So through this, interest rate is determined. Okay? Yeah. Any question up now? Any question you all can ask, or you can send me message. Okay. Demand for money in the liquidity preference framework, right? As the interest rate increases, the opportunity cost of holding money increases. The relative expected return of money decreases, and therefore quantity demand of money decreases. That's what I explained to you. Keep in mind again, I just mentioned, when the interest rate increases, right? If you keep your wealth on money, the opportunity cost will be higher, because if you invest in bonds, you can earn more, right? So the relative expected return of money decreases. Therefore, the quantity demanded of money decreases, right? So in a interest rate rising scenario, the quantity demanded of money will decline. Why? Because of the opportunity cost. Yeah, right. Now you know what is money demand curve, what is money supply curve, and then how to establish interest rate equilibrium, and then what will happen if the interest rate increases or interest rate decreases. as I always say, interest rate or price or whatever, right, which are like indicated in the y-axis, if that is moving, then the quantity will move along with the curve, right? Okay, now shift in the demand for money. Next, now there are other factors that can influence the demand for money. What are those? It can be income effect, it can be price level effect. So let's see the income effect and price level effect, how they change this demand for money curve, right? Okay, first look into this income effect. A higher level of income causes the demand for money at each interest rate to increase and the demand curve to shift to the right. Right? Clear? Now, I'll explain. Now, when your income, as I said, okay, I'm getting an income, so I decide where to invest on bond, or like I'm going to keep as some money. I decide, okay, half of them on bond and half of them as money, right? Because I need return as well as I want to keep as a highly liquid assets also. Why need that? To carry out transaction, right? Okay, so when my income increases, right? When my income increases, then my wealth increase. Now I have to decide where to keep, right? On bond, whole amount on bond or in the money. So usually when the income increases, wealth increases, I will increase my consumption, maybe at different pace or speed, but I will try to do more transactions. The propensity to consume may be different. Maybe I can spend 10% of the incremental amount, or I can spend 5% of the incremental amount, or I can spend 50% of the incremental amount of my income, but I will increase my transaction. So I would like to have more money compared to previous holding. That's what it says. Demand curve will shift to right. So with the income effect, the money demand curve will shift to right. That's obvious, right? Okay. Second point, the price level effect. A rise in the price level causes the demand for money at each interest rate to increase and the demand curve to shift to the right. Right? Okay, now you have to think in a price level effect, a rise in the price level. Right? What do you mean by rise in the price level? What do you mean by price level? It's the general price level of a country. If rising means that's the inflation. Okay, so when the inflation rises, right, what will happen? Now, demand curve, because they need more money, right? So then demand curve to shift to the right. Is that clear? They need more money, right? Because the prices are going up now, right? People care about their money of holding in real terms. Okay, clear? Right. Look at this. Okay, so now you know the demand for money, the curve can be shifted, or like can move to the right based on income effect or price level effect, right? That is the demand curve. Now look at the supply curve, right? As I mentioned, in this context, we assume that supply of money is controlled by the central bank. An increase in the money supply engineered by Federal Reserve. Okay, it's whatever the reasons. That's what it has been mentioned, like engineered by Federal Reserve. Federal Reserve means it's a central bank in United States, right? So increase in the money supply will shift the supply curve for money to the right. Now what happened? So as I said earlier, you can see again, right? Previous slides. Now this money supply curve, when the central bank increases the money supply curve, it will move to right. And another straight line perpendicular to the x-axis, right? Nothing else will happen, right? So central bank, for whatever the reason, increase the money supply, right? Okay, so the money supply curve will move to the right. Or whatever the reason, if they reduce the money supply, then move to left. That's it. Okay, now let's see how this liquidity preference framework capture the changes in equilibrium, right? Okay, I'll show this. When the income increases, money demand will increase. That means you can see here, right? Money demand from MD1 moving to MD2. So when the money demand increases, the interest rate goes up, I2, right? Okay, second, look at this. Price level. When the price level goes up, then money demands goes up. When the money demand goes up, interest rate goes up, right? Other one is, third option is money supply. When the money supply goes up, money demand, money supply goes up, right? You can see here, then the demand curve as it is, then your money supply from MS1 to MS2, right? Due to that, your interest rates come down, I2, right? Maybe the reverse will happen if the changes are other way around. So because of these reasons, the equilibrium interest rate would change. That's what liquidity preference framework says. Now we have we have seen now so many theories, right? You have to keep in mind everything. How to determine interest rate and what are the factors forces this equilibrium interest rate to change. Clear? Okay. Okay. Now, there may be a little bit confusion, but you have to go through again and see. Under this, our interest rate analysis title, we are looking at different perspective. How an interest rate can be determined in the market. It can be desired savings and investment. It could be through loanable fund theory. It could be through demand and supply of assets. It could be through liquidity preference framework. So it's slightly right, different models, and talked about different kinds of interest rate scenarios. Right? Okay. And now, response to a change in income or price level. A rise in income or price level shift the money demand curve rightward, right? MD1. So if something happened to the income to rise or price level to rise, then demand curve will be shifted to MD2 from MD1. Now your equilibrium interest rate moving from point 1 to point 2. Clear? Okay. Now you should be able to give these graphs and analysis when the questions are asked in this liquidity preference here, right? So you should be clear on this. Similarly, now you can see response to change in the money supply. Now, when the money supply increases, that means like money supply curve moving towards right. That means MS1 move to MS2. Therefore, the equilibrium interest rate falls from I1 to I2. Right? Clear? Okay. Now we have seen how this liquidity preference framework works and give us the equilibrium interest rate. So you can have a brief understanding now. So I can give you the key points. The liquidity preference analysis seems to lead to the conclusion that an increase in money supply will lower interest rate. That's clear. And then this conclusion has important policy implication because it has frequently caused politicians to call for a more rapid growth of money supply in an effort to drive interest rate down. Right? You should be able to understand. Now you have seen that when you increase the money supply, the interest rate will go down. So what will happen in political economics? If they wanted to bring down the interest rate, they will force central bank to increase the money supply. But in practical, sometimes it may not happen as expected. That's what the Milton Friedman says. An increase in the money supply might not leave everything else equal, because whenever we study economics, or like in this theory, we say everything else equal. So others hold fixed, right? But it may not be the case. Others may not be fixed and will have other effects on the economy that may make interest rate rise. Even though this says, but in economy, other variables are there. They won't be fixed. They also would be changing. Then, right? Whatever, even though you increase the money supply, the interest rate can rise. If these effects are substantial, it is entirely possible that when the money supply increases, the interest rate may also increase, right? So that you have to keep in mind. But based on the liquidity preference theory, if others are fixed, then definitely you can see, okay, when the money supply increases, the interest rate will be lower. Okay. An increasing money supply is an expansionary influence on the economy that we know, right? The central bank, let's assume, like as an example, central bank prints money, right? So it's a expansionary policy measures, right? It should raise national income and wealth, right? It should raise national income and wealth. Okay, right. If I want to just give some hint on that now, you increase the money supply, so people have more money now. They want more goods and services, so then firms, they produce more, then your national income increases, through that your wealth increases. That's what from the beginning I discussed the economic system and its flow of goods and services and flow of finance, right? Fund flow, right? So you can keep in that mind and always related to any argument in macroeconomic perspective. So both the liquidity preference and bond supply and demand framework. So both the liquidity preference we have seen now and bond supply and demand framework we have seen earlier indicates that interest rate will then rise, right? Okay. Income effect is a rise in interest rate in response to the high level of income, right? A one-time increase in the money supply will cause price to rise to a permanently higher level by the end of the year, right? The interest rate will rise via the increased prices. So price level effect remains even after price have stopped rising. Clear? Now, just to elaborate on that, you increase the money supply one time, right? When you increase the money supply, you demand more, right? So then price will go up, right? But when you like increase the money supply one time, so the price will go up until end of the year, right? But due to this increased prices, your interest rate will rise. That's what it says. Price level effect remains even after prices have stopped rising. A rising price level will raise interest rate because people will expect inflation to be higher over the course of the year, right? When the price level stop rising, expectation of inflation will return to zero, right? So you can see the expected inflation also having the impact on that. So expected inflation effect persist only as long as price level continue to rise, right? Okay, now two effect you could see, one is price level effect, other one is expected inflation effect. So these two can support or like influence the interest rate, right? Okay, now you can read this explanation, right? Okay, you can see this graph, right? Money and interest rate, what happens, the graph says the money and interest rate, how they are moving, money growth rate and interest rate in US like 1950 to 2017. So you can see the changes, how that in real life. Okay, um, just have an idea. Okay, next I'm going to move into the different important area under interest rate analysis, that is risk structure of interest rate, right? Now you have to understand how our risk structure of interest rate behave, right? So bond with the same maturity have different interest rate due to default risk, liquidity, tax consideration. Now you can have 5-year bonds, several bonds, but their interest rate may be different, right? Maybe 5-year treasury bond, the interest rate that carry the interest rate may be 10%. The 5-year corporate bond that may carry 15%, right? Or 5-year even corporate bonds, maybe if there's any like corporate bonds of Apple company that may be traded at 2%, or maybe Microsoft maybe 5%. So like same maturity but different interest rate. So the reasons behind that may be, one is default risk, other one is liquidity, third one is tax consideration. Now in this graph you can see the corporate AAA bonds I have given, right? Corporate BAA bonds I have given, and US government long-term bonds is there, and state and local government municipal bonds are there. During the period 1919 to 2017, you can see the annual yield of these different bonds. See the interest rate, nothing is similar, but moving the direction is similar but different rate of interest. Now you can see the state and local government municipal is very low, and then US government long-term bonds, then corporate AAA bonds, and the highest interest rate is for corporate BAA bonds. So there should be something, right? There should be something for these rate differences. The maturities are same. Okay? There should be something for these rate differences, right? So this is called risk structure of interest rates. Let's see. First, default risk. I said like three factors: default risk, liquidity, and tax consideration. The first one is default risk. What do you mean by default risk? Probability that the issuer of the bond is unable to or unwilling to make interest payment or pay off the face value. Now, what is default risk in layman words? I borrow from you and I have to pay back, and now I am saying like I am not going to pay. So probability of saying that is the default risk. So probability that issuer of the bond is unable to or willing to make interest payment or pay off the face value. That's a default risk. Or some in some explanation, in other perspective, we can call as credit risk as well, right? Okay. But we have to see here, US Treasury bonds are considered default free. In other terms, credit risk free, right? If it is a government can raise taxes, or like in other words, like if you take Sri Lanka, the treasury bills and bonds are default risk free. Why? Because that bonds are in rupee denomination. At any time they can pay back because that's rupee. They can raise rupee through various means, maybe borrowings, maybe printing, so you can raise money. So these are default free. But now there can be other corporates. They also issue bonds, corporate bonds. There should be a default risk because they can't print money, or it's maybe very difficult to borrow because already borrowed, right? So risky. So the risk premium would be added to the interest rate. The spread between, so that means the spread between the interest rate on bond with default risk and interest rate on treasury bonds. Now, let's assume the government treasury bond rate is 10%, and John Keel's bonds may be example, right? Bonds may be traded at 12%. These 2% are the premium for risk premium. Clear? Okay. Right. Now you can see here, response to an increase in default risk on corporate bonds, right? In this graph, we have given quantity, like first one is corporate bond market, and second graph is treasury bond market. That means default free bond market, right? Clear? Just have a look. Now, I'll go to the first step. An increase in default risk shift the demand curve for corporate bond left. Now see the corporate bond graph. The y-axis price of bonds and x is quantity of corporate bonds. Initially, its demand for corporate bonds DZ1, and because of the increase in default risk, that shift to the left. So how that increase in default risk can happen? Maybe various reasons. So that company may be making losses, right? Maybe higher borrowings and very lower liquidity. So maybe the weakness in the company. So then their default risk is increased. Right? When the default risk is increases, then definitely the demand for corporate bond will come down. That means curve is moving left. When the curve is moving left, you can see the supply curve of corporate bond, right? So it's SC. Now due to this, now price come down. When the price comes down, it moves PC1 to PC2. So when the default risk increases, the corporate bonds prices are coming down. In other hand, what will happen? So people will be shifting from corporate bonds to treasury bond or default free bonds, right? Then the demand of this risk free bond will increase. That means the demand curve for treasury bond from DT1, it will move to D2, DT2, red color. But the supply of treasury bond curve as it is, nothing changed. So what will happen to the price? Price will go from PT1 to PT2 up, right? Now you can see the price changes. Now the current price after default risk increases, the price of treasury bond or risk-free bond is now at PT2. But same thing at the corporate bond market, the price is PC2. Now I can see the upper limit called IT2 and lower limit of IC2. That is the risk premium now. Because of the riskiness, the corporate bond is traded at PC2 and treasury bond is traded at PT2. So the difference between IC2 and IT2 are the risk premium, right? So step 3, you can read and see which raises the price of treasury bond and lowers the price of corporate bonds and therefore lowers the interest rate on treasury bonds and raises the rate on corporate bonds, thereby increasing the spread between the interest rates on corporate versus treasury bonds. Clear? Okay, so when the prices, right? So third one. So again, you have to apply that. When the prices goes up, what will happen to the interest? Will come down. When the prices are coming down, interest will go up, right? So this is the changes will happen in response to an increase in default risk on corporate bonds. Okay, now you know under risk structure of interest rate how changes in default risk influence the interest rate. Clear? Okay. Now you can see this is for the references I have given. Risk structure of interest rate, right? Based on the risk, right? You can see this rating agencies, Moody's, Standard & Poor's, and Fitch, 3 key rating agencies. They have some kind of ratings, right? So that ratings give you some indications whether you can, whether these investments are good or bad or kind of, to support your decisions. right? Nowadays, very famous, these rating agencies, and so many people or so many firms, or like they rely on these their ratings, right? You can see this is the investment rating. Now that can be like the three agencies are giving three different ratings, right? Formulas, but you can have a kind of ceilings for meaningfulness, right? So if all are prime maximum safety investment, right, they will, you know what is rating agency, now I just explained, they will give you a rating based on the risk appetite of the assets, right? It can be a bond, it can be a share, it can be a loan portfolio, it can be a company or whatever it is, right? They will give different kinds of rating, right? One of the ratings are investment rating. So here, like if you take like Moody's AAA and S&P AAA and Fitch AAA, that means that bond is like prime maximum safety, you don't have to worry about that AAA rating. If it is a double A plus, and then for Moody says double A1, but other two are saying double A plus, then high grade, high quality. So like that, you know, so different ratings they are giving. So this is one of the indicator for default risk. Okay, even just I have given all that their ratings, you can keep it in mind, right? If you want to explore this more, how this happening and all, you can go to their website and see, right? There can be explanation on this, right? Okay, now is an just like in the past, the actual reality, right, extracted from the book, like a global financial crisis and a BW treasury spread. Starting in August 2007, I explained to you the very first class how that contagion effect happens due to the subprime mortgage market collapse, right? So stating like you can see like collapse of subprime mortgage market led to large losses among financial institutions. We know that. As a consequence, many investors began to doubt the financial health of corporations with low credit ratings such as BW, and even the reliability of the ratings themselves, right? The perceived increase in default risk for BW bond made them less desirable at any given price, right? So this is an example I have given to you, right? So you can read further in the internet, right? What happened to those ratings and lower rating bonds and companies, what happened to their prices? You just Google it and see, right? Okay. Now we have seen default risk and then liquidity. The relative ease with which asset can be converted to cash, right? So based on that, the interest rate may be vary, right? Cost of selling a bond, right? So I will go back and show you, right, why the difference, like same maturity but different bonds having different interest rate. One, we just look into that default risk. Other one is liquidity. If you can, if it is highly liquid, so you can easily convert into cash, the interest rate may be, yeah, yeah, so maybe different from than illiquid one, right? So now cost of selling, yeah, one of the, that's when we say easy, that's what I say, like cost of selling may be high, right, or maybe low, or number of buyers sellers in the bond market, so those decides, right, interest rates, right? That means like risk structure of interest rate, riskiness of the bond. And the other one is income tax consideration. Interest rate payments on municipal bonds are exempted from federal income tax. right? So when the tax is in place, your effective interest rate will be low, because like you have to deduct your tax rate from your interest rate. So your real return will be lesser than your nominal return. Clear? So that also will have impact on the price of the bond. So when the price of the bond changes, definitely interest rate is going to be changed. Right? I'll show you here now. You can see this one. In this graph, you can see the state and local government municipal. Right? Annual yield. Right? It's low. Right? Compared to other bonds. Right? Because like you don't need to pay the taxes for municipal bonds. Then you can give it a lower interest rate, because like real interest rate is high for that. Clear? Okay. So yes, that's what I have given here. So income tax also will have an impact on the structure of interest rate. Now you can see here interest rate on municipal and treasury bonds. The first one chart says quantity of municipal bonds, market for municipal bonds, and second V chart or graph says market for treasury bonds. Now look at the step one. Tax-free status shift the demand for municipal bonds to right. Now let's assume, as I said, the first one, the demand for municipal bond was at DM1. Now because of the tax-free status, demand increases, because like people think, okay, I don't need to pay taxes, so my real return is high now. So then I'm going to buy more, then demand increases. So when the demand increases, price will go up. Clear? Right. So step two, you can see the market for treasury bonds. What will happen? Shift the demand for treasury bonds to the left, because they have to pay tax. So then people will be moving from treasury bonds to municipal bond. So then demand for treasury bond will come down. When the demand for treasury bill comes down, then price is going to be lower from PT1 to PT2. Right? Okay. So then you can see with the results that municipal bonds end up with higher price and lower interest rate than on treasury bonds. Right? So when the price is high, an interest rate will automatically low. And that's what we study. Right? Okay. So you can see how that interest rate changes. Any question up to now? Okay, there's another graph, right? These are very important. Like you can see and understand easily how that happens in real life. Bonds with identical risk, liquidity, and tax characteristic may have different interest rates still, right? The same risk, liquidity, tax characteristic, but still you may have different interest rate, because the time remaining to maturity is different. You have to think about, as we discussed, other than these two, but always the distance to the maturity. If that is vary, definitely interest is going to be vary. Now you can see 3-year treasury bills, 20-year bond, and 3 to 5 year averages. So it has been given, right? Normally you can see the 3 month bills, is at a lower rate, and 20-year bond average, that's a higher rate, because time to maturity, so that means remaining maturity is higher. Okay, now we call it term structure of interest rate, what we have seen, right? So the risk structure we have seen, and then we have seen term structure of interest rate. Even though the risk structure is similar, due to the term structure, so interest rate may be varying, right? Okay, that's what we have seen. So yield curve, a plot of the yield on bonds with different terms of maturity, but the same risk, liquidity, and tax consideration. As I explained to you, upward sloping long-term rates are above short-term rates. Short and long-term rates are the same if it is flat, and if it is inverted, long-term rates are below the short-term rates. So actually, normally, it's always upward sloping, but in an extraordinary situation, it can be flat, it can be inverted, right? So that also you should be able to understand. Okay, term structure of interest rate. The theory of the term structure of interest rate must explain the following five, right? One is the interest rate on bonds of different maturities move together over time, right? One. When short-term interest rates are low, yield curves are more likely to have an upward slope. When short-term rates are high, yield curve are more likely to slow downward and be inverted, right? Third one, yield curves always are almost always slope upward, right? This is what I always say. The yield curves almost always slope upward, right? That is the gentle term. Okay, we will look into that in detail. So, three theories to explain the three facts. One is expectation theory that explains the first two facts but not the third, right? So second, the segmented market theory explains the third fact but not the first two. The third, liquidity premium theory, combines the two theories to explain all three facts. So here you should understand what is expectation theory, what is segmented theory, and what is liquidity premium theory. That's it, right? I want to go into more details, but it's kind of introductions for these theories, right? And how these theories can be used to analyze term structure of interest rate. Clear? Any question up to now? Okay, the first one, expectation theory. We have only one thing, like we have seen so many theories, right? You have a mind mapping, put together all these theories and see how we can analyze the interest rate. Otherwise, maybe you may be confused. I know, without a practical experience, maybe a little bit difficult to coordinate all these theories and get the essence out of that. So you prepare a mind mapping and put all together and see how best you can understand this one, right? Okay, let's come to this expectation theory. This theory right, articulate that the interest rate on long-term bond will equal an average of the short-term interest rates. That's if people expect to occur over the life of the long-term bond, right? Buyers of the bond don't prefer bonds of one maturity over another. They will not hold any quantity of a bond if it is expected return is less than that of another bond with a different maturity, right? Okay, so these are the expectation, right? Bondholder consider bonds with different maturities to be perfect substitute, right? I will explain with the example. Let the current rate on 1 year bond be 6%. Okay, 1 year bond is 6%. Now you expect the interest rate on 1 year bond to be 8% next year. So this year 6% and next year 8%. Then the expected return of buying two 1 year bond average, right? 7%. That means 6 plus 8% divided by 2. Okay. The interest rate on a 2 year bond must be 7% for you to be willing to purchase it, right? Now let's assume now what you can do now today, right? Now the question is like this: you're going to buy bond, right? How we are going to buy? That's the question. There's an expectation that you think the current year is 6%, but next year is going to be 8%. You can buy this bond in different ways. You can buy today for 2 year bond, or you can buy 1 year bond and then reinvest that amount for another year. So you can buy 2 times, or you can buy at one call, right, for 2 year bond. Which one you are going to choose? Now let's say first option, you buy first year, that means you earn 6%, and again you are going to buy it or reinvest it at 8%. So you will get 6 plus 8%, 14%, right? But in the market there are a bond for 2 years. That bond's interest rate should be at least 7%, because now, right, you can altogether get for 2 years 14%. So if there's a bond, 2 year bond, at least they should pay 7% per year, then only you can reach that 14% return. Got it? So now the interest rate on 2 year bond must be 7% for you to be willing to purchase it. Otherwise, you are not going to buy. Otherwise, what you do, you will buy today for 1 year, 6%, and after 1 year, you will buy, reinvest again at 8%. This is expectation. Clear? Okay. Okay. Here, like it has been given, right? The example, you can go through this one and see, right? You can easily understand. Okay, I have given the calculation for you. If time permits, you can go through this for your knowledge, right? how this expectation theory works through a computation, right? The first period and second period, how that happens, right? uh, and you can go obtain period and see, right? Okay, so the final take home point, kind of like, points you have to remember on the expectation theory. This theory explains why the term structure of interest rate changes at different times. Of course, we have seen why interest rate on bonds with different maturities move together over time, right? Fact one. And why yield curve tend to slope up when short-term rates are low and slope down when short-term rates are high. That's a fact two. And cannot explain why yield curve usually slope upward. Fact three, right? So expectation theory has given these explanation, that is 1 and 2. Okay, right. Look at this segmented market theory. It says like bonds of different maturities are not substitute at all, right? So the segment, so here like it clearly says like you, if these bonds are having different maturities, you can't consider those as substitute. So it says like interest rate of each bond is determined by the demand and supply of those categories. Because like investors have preferences for bonds of one maturity over another. I may be preferred for 1 year, another one maybe 2 years, right? So he can go for 2 years. I never go because like I have the interest with the 1 year bond. I don't want 2 years bond. So we have different preferences. If investors generally prefer bond with shorter maturities that have less interest rate risk, then this explains why yield curve usually slope upward. Okay, so then the third fact, we saw like yield curves usually slope upwards. So if the investors generally prefer bonds with shorter maturities because that have less interest rate risk, we have seen early in the discussion, when the remaining maturity is longer, so vulnerability is high, so that means interest rate risk is high, right? That's what it says. Like if the investor generally prefer bonds with shorter maturities because that have less interest rate risk, then this explains why yield curve usually slope upward, right? This is segmented market theory, right? And liquidity premium and preferred habitat theories, right? Now, earlier, I'll go back and show you, right? So, term structure can explain the three facts through three theories. One is expectation theory, second one is segmented market theory, and third one is liquidity premium theory, right? So we have seen the first two theories, and now finally I'm going to discuss with you liquidity premium and preferred habitat theories, right? The interest rate on long-term bond will equal an average of short-term interest rate expected to occur over the life of the long-term bond plus a liquidity premium that responds to supply and demand condition of that bond, right? Now it says actually like the short-term interest rate, right, that will be reflected in the long-term bond. In addition to that, the liquidity premium also inbuilt to the interest rate of that long-term bond, right? Uh, Accordingly, it says the bonds of different maturities are partial substitute. You can fully substitute the short-term and long-term bond, but some extent the short-term bonds influence the long-term bond price because of the right. In addition to that, liquidity premium is included, right? That's the case. Clear? Okay, now I've given the formula just for understanding, right? There won't be any computation or something like that. But now you can see the L is the liquidity premium for the N period bond at time T, right? So LNT is the liquidity premium, right? So this rises with the term to maturity, right? So this is others are expected interest rate for the periods t plus 1 t plus 2 like that, right? And with that you are going to add liquidity premium as well, right? That's what I said. So then LNT is always positive because like longer term bonds always need this premium, liquidity premium, and rises with the term to maturity, right? When the term to maturity increases, so you need more liquidity premium, right? Clear? Okay, so then if you look at this preferred habitat theory, investors have a preference for bonds of one maturity over another, right? They'll be willing to buy bonds of different maturities only if they earn a somewhat higher expected return. Investors are likely to prefer short-term bond over long-term bond. So preferred habitat theory says how investors behave in terms of maturity. So now you can see here the relationship between the liquidity premium and the expectation theory, right? Okay, now interest rate on the y-axis and years to maturity on the x-axis, and you can see the expected theory yield curve for that expectation is fixed for the different maturities. But as I said, the liquidity premium theory says, so liquidity premium should be added to the expectation theory's yield curve. So that yield, right? So you are going to add liquidity premium to the yield curve and expectation theory, but that liquidity premium also going to increase over the period, years to maturity. That's what the curve you can see here. Clear? Okay. Now you have to, like in these theories, we have to just understand what is that. Not in detail, right? Just to give some hints. Okay. These also can happen in influencing interest rate. That's what I want to mention. Okay. So you can see interest rate on different maturities. Or any question? Okay. Interest rate on different maturity bonds move together over time. That is explained by the first term in equation, right? Yield curve tend to slope upward when short-term rates are low and to be inverted when short-term rates are high, explained by the liquidity premium term. in the first case and by a low expected average in the second case. And yield curves typically slope upward, especially explained by a larger liquidity premium as the term to maturity lengthens, right? So I've given the explanation to the chart as well. So this is I've given the relationship between yield to maturity and term to maturity in different scenarios, right? The yield curves and the market's expectation of future short-term interest rate according to the liquidity premium theory. So based on the liquidity premium theory, so how this yield curve behave, that's what you can see. That's what I earlier said. It can be upward sloping, or that's a steeply upward or mildly upward, or right flat yield curve or downward, right? It can be in any scenarios, right? So you can think of. So people think, why I just want to clarify again, or like give a hint on that. So normally it's an upward slope, right? But special circumstances it can be flat and downward as well. Okay, this is for sake of understanding. I have given a chart showing that what happens to yield curve for US government bonds at different period. You can see like mostly like in a general terms all upwards, but still, right, you can see there are different like slopes, right? Okay, so it can happen. Okay, today, yeah, we have done this interest rate analysis. So I hope you understood, and if there's any doubts, you can send me a message even later stage, right, if time permits, because like we have another 2 classes, so we have to discuss monetary policy and exchange rates. And through the first class I have discussed intermediaries, so like I have to touch upon some laws as well, right, legal framework as well. So another 2 classes mainly will be learning exchange rate analysis and monetary policy analysis. In addition to that, maybe legal framework. So another 2 classes. So again, I just repeat you, like exams questions will be within these discussions, and so please try to understand if there's any question, and you can see the books as well for the explanation, and if you have any questions you can ask. So then thank you so much. See you all in the next class or next Sunday. Thank you.